No, absolutely. I mean, what's really helped is OPEC Plus's cuts from start of this year, which they announced in December meeting, has definitely helped rebalance the market. And on top of that, their overcompliance has gone even further along the way in taking away that extra barrel out of the market. In addition to that, despite the benign outlook for demand growth this year or next for that matter, what we are also seeing is some of the non-OPEC producers curtailing their production, such as Canada. And on top of that, this is our view that we have been publishing, that even US production growth in the first half of the year should slow down, especially given the slowdown in completions we have seen at the end of last year. Capital discipline is the mantra for producers right now in the US, as well as also the drop in oil prices at the end of last year should have the lagged effect in which first half should show slower growth, but second half, no doubt, should see increased growth in production.
So just to be clear, the 30% gain in the price of oil so far this year, you're pinning to supply, not some improved demand picture. For
Totally. It's a very supply-driven market right now, oil markets, especially because of both the interaction of both OPEC Pluses taking away extra barrels out of the market, but also US and non-OPEC producers adding further to the tightness. I would say from the US angle, it's basically lower growth, which in a way is supportive.
When you see data like this morning, German manufacturing, does that get you concerned about demand outlook for the rest of the year?
Well, we are already taking a demand outlook or demand growth expectation of 1.1 million barrels this year, which is lower already compared to last year, where last year was 1.3. I think what's the problem with the markets right now when it comes to oil is that if you look at the near-term fundamentals for oil, they're quite tight and quite supportive. But I think the markets in general are so latched on to the macro news. So anything negative on macro tends to have a roll-on effect in all risky assets, and oil, of course, along with it. And we've seen that happen at least 3 to 4 times in the last 15 to 18 months. And that's why this is something that we're living with, and we'll have to live with in 2019 as well. But as soon as markets tend to focus away from macro news, especially for oil and commodities, you will start to notice that oil support is quite well supported by strong fundamentals in the very near term.
So what's your target for the end of the year?
End of the year is different. It's the first half of this year, which is middle of this year, we see still oil going towards 75 Brent, purely because the physical market tightness because of the cutbacks from supply side are going to help. But end of the year,
second half?
Yes, and by the end of the second half, we go more towards lower 60s, in the 60 range, just because the slowdown in demand growth, as well as the return of US supply, will start to weaken the balances. So you're looking at more mid to high 60s rather than now 70s handle by the end of this year.